So my interest expense should go up to 52, 10% of the bank loan. That's the interest rate, just like last year. I'm assuming the interest rate is going to remain the same. So if my interest rate on loans remains the same and my loans go from 300 up to 524, then my interest expense should go from 30 up to 52, 52.4. We'll round it off to 52. So now if my interest expense is forecasted to go up to 52, operating profit minus forecasted interest expense gives me forecasted income before taxes of 80. Beautiful. Now I got my income taxes, my income tax expense. What's my best assumption with respect to income tax expense? My best assumption with respect to income tax expense is that the rate is going to remain the same. So let's figure out the rate. What was the rate last year? The rate last year, I had $30 in income taxes divided by $70 in income before taxes. That's a 43% rate. You can calculate that and confirm it on your own. So my best assumption is the rate's going to stay the same. 43%, just like last year. So if my forecasted income before taxes is 80 and my income tax rate is 43%, 80 times 43%, that's 34. That's my forecasted income tax next year, with the rate being the same as it was last year. 80 minus 34 gives me forecasted net income of 46. This is forecasted net income of 46. This right here is my pro forma income statement for next year. It hasn't happened yet. It's my pro forma income statement. Beautiful. Now we're not done because we're still working on our pro forma balance sheet. Pro forma balance sheet. We already said that our forecasted assets are going to be 864. How about accounts payable? Well, accounts payable are one of those things that just go up naturally. If I have 40% more business, I'm going to have 40% more purchases of inventory, so I'm going to have 40% more accounts payable. So this is going to go up naturally from 100 up to 140. That's just going to happen naturally. I already decided that loans payable were going to be 524. That was because the loans were going to go up by 224, so that's going to be 524. All I've got left is this stockholders' equity, and we need to do a little calculation here. Last year, the stockholders' equity was 160. Beginning equity, 160. What causes stockholders' equity to go up? Well, new owner investment. And we don't know what that is. We haven't assumed anything about that. So let's just set that to the side with some question marks. But we do know that equity goes up. The retained earnings portion goes up with the amount of net income. Or forecasted net income is right here. It's 46. Forecasted net income, 46. Forecasted net income, 46. Forecasted dividends, the preliminary decision we've made on dividends is right here. Our dividends are planned to be 6. So our equity is going to go up by the amount of forecasted net income and down by the amount of forecasted dividends. 160 plus 46 minus 60 is 200. That's our preliminary forecast of ending equity. That's where this 200 comes in. Now we got to check and see if this works. I know it does because I cheated with this 524 because I knew what the answer was. I didn't want it to come out wrong, but here it is. 140 plus 524 plus 200, 864. Is that right? Of course it's right. Because the accounting equation always has to be true. If we expect to have $864 in assets, then we're going to have $864 in financing. Combination of accounts payable, bank loans payable, and total stockholders' equity, also 864. Now we need to stop here for just a minute, because you can say, well, what if it hadn't turned out exactly right? Well, then that would tell us that we've got to change something. We need to say, well, we need some extra stockholder investment, or we need to pay bigger dividends, or maybe we need to borrow more money. We need to change the loans. We need to do whatever needs to happen to cause this number, total liabilities and equities, and total assets to be exactly 864. That's the numerical discipline imposed on us by accounting. There's our forecasted income statement right there, or pro forma income statement. There's our pro forma balance sheet right there. Look at it. That's pretty. All right, let's say that we don't like the pro forma financial statements that we just made. And we got a pro forma income statement here. We got a pro forma balance sheet. I don't like it. That income's not high enough. That's too much borrowing, whatever. I don't like what I see. Well, remember, this is just a forecast. If you don't like the implications of the forecast, if you don't like that much borrowing, if you don't like net income that's low, and you might not like the net income that's that low, because take a look at it. Our sales our forecast to go up by 40%, but our net income is only forecasted to go up from 40 to 46. That's not a very big increase. We'd want it to go up more, so I don't like that. Okay, well, if you don't like the implications of the forecast, you got to change one or more of the assumptions, because let's go back. See those simple assumptions right there? Hey, with those 4 assumptions, you can't avoid that income statement and that balance sheet. If you don't like that income statement and that balance sheet, you got to change one of these assumptions. That's why we do this whole thing. That's why doing this on paper in advance, it's a lot easier to change things before you ever start than halfway through the year. That's why we construct pro forma financial statements. We can construct them to run our business better, but also as outsiders, we can say, okay, here's what it looks like Darrell Company's going to do, and their income next year is going to be 46. Is that enough? Is that enough for them to be able to repay the loan? Is that enough to justify the investment that I'm expected to make? I can make decisions about the future based on these pro forma financial statements.